The live price for Nokia stock on the New York Stock Exchange, trading under the ticker symbol NOK, is exactly $16.97 per share, capturing a major intraday surge of 4.46% during today's session on June 2, 2026. This aggressive movement has pushed the telecom titan to a brand new 52-week high, bringing its total year-to-date gains to a massive 149.62%. This explosive upward trajectory stands out sharply in a market where telecom hardware companies have traditionally been treated as slow, dividend-focused legacy plays. The trading volume today has already cleared 75.6 million shares, signaling heavy institutional accumulation rather than simple retail speculation. The immediate catalyst driving this specific afternoon breakout is a newly revealed research note highlighting Nokia stock as a quiet but fast-rising player within the broader NVIDIA stock ecosystem. Market tracking accounts have exposed that Nokia has quietly become one of the top-performing assets aligned with next-generation data center optical buildouts. While everyday retail participants look for investment help on basic online investing websites or focus purely on mainstream tech names via the Robinhood app, large institutional funds are quietly executing major position shifts. Recent filings show a striking divergence in ownership trends. For instance, FMR LLC, the parent company of Fidelity Investments, aggressively added over 57 million shares of Nokia stock to its portfolio during the first quarter of 2026 alone, expanding its position by more than 34%. This institutional accumulation directly challenges the baseline expectation most everyday market participants have held for years. When people think of Nokia, they picture ancient mobile phones or slow-moving 5G infrastructure contracts that carry painfully low profit margins. The common ground among casual retail self-investing circles is that Nokia is a value trap destined to trade sideways forever between $4 and $5. But the reality unfolding across professional trading desks is completely different. The company is experiencing a structural pricing transformation because it sits directly at the intersection of high-speed data transmission and hardware infrastructure. As data centers scale up to process massive artificial intelligence workloads, traditional copper wiring creates physical bottlenecks. The market is waking up to the fact that Nokia dominates the high-performance optical networking sector, which is essential to link massive arrays of graphics processing units together without latency. Looking closely at the daily swings and technical momentum, this shift from a legacy telecom provider to an infrastructure provider has created a steep valuation premium. Nokia stock is currently trading at a trailing price-to-earnings ratio of 101.49, which jumps down to a forward multiple of roughly 85. This is an incredibly rich valuation for a hardware manufacturer, placing it among the most premium-priced names in the technology sector. The massive price expansion has been fueled by a continuous sequence of earnings surprises and guidance upgrades that caught short sellers completely off guard. When you track the performance on active platforms like Interactive Brokers Trading or monitor the inflows through a basic individual brokerage account, the order flow reveals a persistent bid that prevents any meaningful technical pullbacks. The underlying financial health supporting this trading velocity became undeniable during the company's recent Q1 2026 financial report. Nokia delivered net sales of 4.5 billion euros, marking a 4% growth year-over-year on a constant currency and portfolio basis. While a 4% top-line increase might look modest on a basic screening tool on common investing sites, the real magic happened in the margin expansion. Nokia's comparable gross margins expanded by a substantial 320 basis points to reach 45.5%. Even more impressive, its comparable operating profits surged by 54% to reach 281 million euros, comfortably sailing past what Wall Street analysts had modeled. The star of the report was the optical networking's division, which posted a blistering 20% year-over-year growth rate. This margin expansion shows how the fundamental business mix is shifting away from low-margin, highly competitive hardware installations towards specialized software and premium optical solutions. In the first quarter of 2026, Nokia's dedicated AI and cloud segment posted a 49% increase in sales, capturing a massive 1 billion euros in fresh orders from hyperscaler data center operators in just a 3-month window. This single segment now commands 8% of total group revenue, up from almost nothing a couple of years ago. This rapid fundamental pivot prompted corporate management to aggressively raise their long-term industry growth projections. They revised their expected compound annual growth rate for the AI and cloud infrastructure market up to 27% through 2028, a massive leap from the 16% rate they had estimated just 5 months prior. This dramatic shift explains why major asset managers are reallocating capital out of traditional software plays and routing it directly into hardware infrastructure components. For anyone running an automated asset allocation through Schwab Intelligent Portfolios or executing manual options trades through the SoFi Invest platform, comparing Nokia to its old self is a massive mistake. The corporate balance sheet has been fortified to support this transition, maintaining a highly secure net cash position of 3.8 billion euros, even after returning capital to shareholders through consistent dividend distributions and covering the integration costs of its recent inferior acquisition. The operational leverage built into this model model means that every incremental euro of high-margin optical sales is dropping straight to the bottom line, which is why full-year 2026 consensus earnings per share estimates are climbing steadily toward the 30-cent mark. To fully understand how Nokia engineered this structural pivot, it helps to step back and look at what the company actually does today. Nokia operates through three core business segments: network infrastructure, mobile networks, and Nokia Technologies. The network infrastructure division is the current growth locomotive, housing the hyper-growth optical systems and high-speed IP routing technologies that modern data centers require. During the recent optical fiber communication conference, Nokia turned heads by launching a completely fresh hardware architecture built around 4 coherent optical building blocks. This specific product release allows enterprise clients to achieve up to a 70% reduction in their total cost of ownership by optimizing power consumption and data throughput. In an environment where power availability is the single largest constraint facing modern data centers, a 70% efficiency gain is an undeniable selling point. Meanwhile, the old-school mobile networks division is no longer the deadweight it used to be. It pulled in 2.5 billion euros in the first quarter, posting a 3% constant currency growth rate. Instead of chasing unprofitable commoditized radio contract rollouts, Nokia has applied intense cost discipline here. The division's gross margins expanded by 430 basis points to an impressive 48.5%, while operating margins moved up to 8.9%. This structural improvement was heavily supported by their cloud-native core software subsegment and their new AI-optimized radio access network technology, which is already locked in 10 major global telecom carriers, including T-Mobile, Vodafone, and SoftBank. Finally, the Nokia Technologies segment continues to act as a highly profitable licensing engine, generating 385 million euros in high-margin royalty revenue from long-term patent agreements spanning consumer electronics, smartphones, and multimedia devices. Please share your thoughts in the comment section below. Comment below how many shares of Nokia stock you currently hold in your portfolio, and whether you are buying more at these all-time highs or looking to take profits. As we look toward the remaining months of 2026, the critical question for anyone engaged in online investing is whether Nokia can successfully maintain this massive valuation premium. The tension between market expectation and fundamental reality will ultimately decide where this stock goes next. Right now, the market's expectation is that Nokia will seamlessly transform into a permanent high-growth infrastructure play, keeping its margins elevated as data centers buy up optical concomics. If the reality of upcoming quarterly reports matches or exceeds that high bar, the stock has room to run as institutional accumulation continues. However, trading at over 100 times trailing earnings leaves absolutely zero margin for error. If hyperscaler spending slows down even slightly, or if supply chain challenges delay product shipments, the downside risk for a stock with this much sudden momentum can be incredibly sharp. For individual investors using premium execution tools like the Interactive Brokers platform or managing their long-term retirement accounts through Fidelity IRAs and Fidelity mutual funds, managing this specific risk requires a deep look at upcoming macro catalysts. The ongoing integration of Infero will be a major operational test, as Nokia needs to successfully combine their portfolios without creating friction for existing enterprise clients. Furthermore, the competitive landscape is shifting quickly. While Nokia currently holds a technological edge with its latest coherent optical architecture, traditional network rivals are pouring billions into their own development pipelines to claw back market share. Ultimately, Nokia's impressive run to $16.97 per share highlights a complete mismatch between past public perception and present operational reality. The old story of a struggling mobile hardware company has been replaced by a highly efficient, highly integrated provider of critical optical data systems. The massive institutional backing from firms like Fidelity Investments and the surging order books from cloud infrastructure clients show that the big money is betting heavily on this turnaround. Yet with a stretched valuation, the stock has turned from a sleepy value play into a high-stakes momentum asset. Investors monitoring this ticker across the Robinhood app, SoFi Active Investing, or individual brokers platforms must look past the superficial hype and closely track gross margin preservation in the coming quarters. The company has proven it can capture the market's imagination. Now it must prove it can deliver the sustained earnings power needed to back up its premium valuation. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video. Comment your thoughts. Share with your friends. Subscribe for more updates.